Having a strong growth ETF can create huge opportunities for gains within a portfolio, and Vanguard's VUG is a common name when talking about these types of growth ETFs. This is a fund that will provide exposure to large cap US companies that have established business models and tend to outperform the market over the long run. In this video, we will go through VUG's strategy, holdings, past performance, dividends, and a couple of comparisons against other popular ETFs like VU and SCHD. So without further ado, let's dive right into it. So the ticker symbol is VUG, but we'll call it VUG throughout this video. So this is an exchange traded fund that's managed by Vanguard, and this is their growth ETF. The strategy for this fund is to track the US large cap growth index. It's a bit different than an ETF like VU that tracks the S&P 500. With this growth approach, it's more concentrated on companies with higher potential returns, but it also comes with some higher exposure to risk. We'll be diving into this a little later in the video as we dissect the past returns. Now, let's take a look at the US Large Cap Growth Index a little closer. So this index includes some of the largest US companies like Apple, Nvidia, Microsoft, and Amazon. A lot of these companies are also found in the S&P 500 index, but the key difference here is that VUG holds just 180 companies. So this means that there's an increased concentration into the companies that make up this index. So the specific sectors that make up this ETF are technology at about 50%, consumer discretionary at about 20%, and industrials at about 9%. Now, when we start looking at these specific companies that make up this ETF, the first one is Apple at 12%, Microsoft at 10%, Nvidia at about 9%, and Amazon at around 7%. These are just the top holdings. Of course, there are 180 companies in total, which you can look through on the Vanguard website if you're interested. So the key difference with this ETF compared to something like VU is the exposure to technology, which really acts as a bit of a double-edged sword. You could have some huge opportunities for growth potential, but also some significant volatility. Let's look into the past performance to get a better idea of how this historical performance has been. So VUG was brought onto the market in 2004. The fund has an average annual total return of about 12% per year. Now, if we narrow our time scale into the last 5 years, VUG has an annual total return of about 18%, which seems great at first glance, but if we take a look at this dip right in the middle of the graph around 2022, we'll pull up the performance data for this year specifically. VUG actually had a negative return of about 33%. Now, comparing this 2022 performance against VU to represent the broader market, so VUG had that negative 33% and VU had a negative 18%. So that's quite a bit difference in terms of performance under those market conditions. Now, of course, there's definitely some light to this fund. If we look at 2023, VUG had some significant returns, and this year alone, its annual return could have been about 48%. And again, comparing this to the broader market here in VU, this would have returned 27%. So these 2 years can provide some information on the past performance of VUG compared to the broader market. But of course, past performance does not guarantee future results. Now let's dive into the dividends for VUG. Now, although this is not intended to be a dividend-focused ETF, they do have about 0.5% dividend yield. If we take a look at this ETF on Seeking Alpha, they have had 20 years of consecutive dividend payouts, but their dividend growth is not really impressive, especially compared to some of the other dividend-focused ETFs like SCHD. Now, of course, this is really one of my favorite parts of this channel, and that is comparing historical performance of ETFs. Let's start by comparing VUG to VU. The time frame used for this comparison is from 2010 to present day, and that constraint is set by VU since that is their inception date. Now, we'll simulate a $10,000 investment. We could see that VUG would have outperformed VU across these years, and based on our $10,000 investment, VUG would now be worth $65,000 and VU would now be $53,000. This works out to be an average annual total return of about 15.2% for VUG and 13.4% for VU, so very competitive in this comparison for both Vanguard funds. If we want to do a bit more comparison with these ETFs, we can start with their holdings. Using this tool called ETF Research Center, we can look at the overlap between VU and VUG. So they have about 138 overlapping holdings, which means that about 78% of VUG's holdings are also in VU. Now, something we keep bringing up is how the company weights are different, and we can see this in their first sector drift. You can see that VUG has an increased exposure to a few sectors, with the main one being tech. VU has a lot of different sectors in financials, healthcare, and consumer staples. Now, if we dive dive into the holdings overlap, starting with VU, Apple, Nvidia, Microsoft all have weights between 6 to 7%. On the other hand, in VUG, with those same top 3 holdings, they have weights between 11 to 13%. So you can see these differences in terms of the concentration of their top holdings. Now let's jump over to another ETF in SCHD and check out the past performance review. So the time frame that we'll be using for this comparison dates back to 2011, and this is set by SCHD's inception date. So two very different objectives in these funds. Of course, VUG is focused on growth, while SCHD is a dividend grower. Now at the end of this time period, VUG would be worth $56,000 and SCHD would be worth $43,000, and the average annualized returns would be 15% for VUG and 12.5% for SCHD. So still very competitive considering these ETFs have very different objectives. If we jump back over to the ETF Research Center, check this out. SCHD versus VUG. There are just 5 overlapping holdings, which make up 2.9% of VUG or 5.1% of SCHD. When we look at the specific sectors, VUG has almost 40% more exposure to technology, and that is a significant difference. On the flip side, SCHD is a little more focused on sectors like consumer staples, energy, and healthcare. These sectors are not as common in VUG, and in terms of company overlap, there's only 5 as you can see here, so very little overlap compared to our last ETF. Now a few more things we should consider about VUG. They have a pretty competitive management expense ratio of about 0.04%, so this means for every $10,000 invested, the fee could be around $4 per year. Many investors would consider this to be a pretty competitive rate, which is something that Vanguard is known for having. So overall, this ETF is very interesting. It has some significant upside potential, but also some significant risk. Although there is a lot of technology exposure, it could fit well in some portfolios depending on your risk tolerance and overall objectives in the portfolio that you're building. If you found this video insightful, please be sure to leave a like and subscribe, and let me know what you think of this ETF in the comments below.